Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is the founder of Adrian Day Asset Management, the man himself, Adrian Day. Great to see you, Mr. Day.
Fine, and thank you very much for asking me.
It was a pleasure to have you on. What are the main drivers, Mr. Day, for gold and silver market going forward?
Oh, we're jumping right into it, eh?
Yeah.
You know, I think all of your listeners know, of course. We all know that there are differences both in the supply structure and the demand structure between gold and silver.
Yeah.
And I'm sure you've talked about those many, many times, and they're important. And they're important for people to understand the differences.
Mm-hmm.
But, given those differences, I frankly was quite surprised when I did some work on this. I was quite surprised to see that, in fact, the largest factor affecting the silver price is global liquidity, just the same as with gold. And so and you can see that in this chart, but now this is just 10 years. And the correlation, of course, the correlation is quite good, but it's exaggerated. So every time global liquidity goes up, as we saw in 2011-12, gold and silver go up by a much greater extent, but they're still quite closely correlated in terms of direction. So there are certainly very important factors affecting silver that don't affect gold and that have nothing to do with global liquidity and nothing to do with silver as a monetary metal. We can talk about that later if you want. I'm sure you've talked about them before. If you look at the end of this graph, where I've circled in yellow, you see gold in blue has diverged from global liquidity. So for the last 12, 16 months, global liquidity shot up, as we know, but the gold price from last August has slid. But what you see for silver is even more dramatic than that. So silver arguably is even more dramatically undervalued than gold.
So you think there's a catch-up play that has to, so either liquidity has to dry up, which is unlikely, or silver and gold need to catch up, one or the other?
You're a comedian.
Yeah. Hey, I'll be here all night. So
yeah, absolutely. Now, again, let's not forget there are other factors. And the most important factor with silver that's different with gold is the change in the market over the last 25 years to the point where there's relatively little pure silver production or even primary silver mines right now. Most silver, as you know, is byproduct silver. And that has and you can see that on this graph here, Peñoles and Fresnillo, the two largest, both Mexican, are both reasonably pure silver companies. But look at Polymetal. Polymetal is a Russian company. It's the third largest silver producer in the world. And silver accounts for about 12% of its revenue. And then, of course, other companies that we all know, like Pan American Silver, Wheaton, which used to be Wheaton Silver, Fortuna Silver. All of these silver companies, we know, have a minority of their revenue comes from silver. In the case of Pan American this year, it's around little under 30% this year. We might expect it to be a little more on an ongoing basis, but this year it's under 30%. And so the point, and Fortuna Silver is around 20% this year in silver. Now, that's very, very significant for a lot of factors, but it's very significant for the silver price because it means that silver production does not respond very much to changes in the price of silver. In other words, if the price of silver drops, the company that's got byproduct silver doesn't decide to stop, Fortuna at their mine in Cayome, at their mine in Peru. They don't decide to stop mining zinc and lead just because the price of silver's gone down. Similarly, they don't decide to increase the production if the price of silver goes up, because that's not their main product at that mine.
No, that totally makes sense, sir. Thank you for pointing that out. One of the other things we wanted to ask you about is, we're in this now taper from the Fed, if you want to call it that. What their version of tightening is reducing the bond buying. But I know you've done a lot of research on this. How does gold and silver typically respond when central banks start tightening?
Yeah, that's an excellent question. And I have written about that actually the last few months. Other things being equal, right? Other things being equal, both gold and silver respond very badly to tightening. Tightening, other things being equal, is bad for gold and silver. But in fact, what you have found from experience, and I've got a graph on this, there you go, this is tightening for gold. Mm-hmm. Every time in the last 20 years, the Fed started tightening, either by tapering or by raising interest rates, gold actually bottomed and turned around. So you look at the last taper in 2013, right at the end of 2013, gold had slid, and the same goes for silver. Gold fell for 6 and 7 months while the Fed was talking about tapering. And while the Fed was threatening to taper. But, the Fed's bite is a lot, the Fed's bark is a lot less than its bite. And, gold bottomed the same day that the Fed actually started tapering. You saw the interest rate hike in December of 2015, the same thing, the very same week that they hiked, gold went up. And the same thing happened this time, right? The Fed last week said, okay, we're definitely going to taper. This is our plan. Gold turned around and went up.
Yeah.
And I think the mark, and the same to a lesser extent, but the same with silver. Again, in 2005, 2013, 2015, each time you had one of those tightening moves, silver responded. And the reason to me is quite clear. As I say, the Fed's bark is worse than its bite. But once they actually start, the market this is my hypothesis, the market realizes that what the Fed's doing is too little too late. I mean, the Fed has left it far too long to try to attack inflation. And that's because of all this, two things. One is this transitory nonsense. And the second thing, transitory is now going to be a little more persistent than we previously thought. Yeah. And President Biden, who a month ago was talking about, don't worry about inflation, it's only transitory, as though he has a clue on inflation and economics. But, 2 days ago, he made that speech in Baltimore when he said, inflation is the most important thing facing the country right now, and it really hurts the working class. And we need to pass my spending bills to contain inflation. Oh, what? Where on earth did he get that from?
Yeah,
I would have more respect for the guy who said, listen, my spending plans are the cause of inflation and are going to make it get worse, but it's worth it. It's worth it to help, poor people, or worth it to send more people to college or whatever. But let's be honest. I mean, gosh, where do they get that from?
Well, the media seems to be totally on board with helping. This has been in the news lately, where the media seems to be trying to convince everyone that inflation's good for you. And it's only the 1% who are hurt by inflation, not everyone else. I mean, they seem to be trying to flip the narrative to convince everyone.
That is just so upside down.
Yeah.
Again, normally, I mean, painting with a broad brush, when you have inflation, the people who are most hurt are the poorest people who spend all their money. If you're wealthy and you're only spending on essentials, you're only spending on food and clothing and housing, you're only spending a small part of your income, you've got a lot of money left over to invest. And in an inflationary period, real estate does well, metals do well, gold does well, stocks do well, Bitcoin does well. All these things do well. And it's the wealthy that have the opportunity to get wealthier in an inflationary period. I mean, this is just so upside down. And frankly, what the Fed and other central banks around the world, this mantra for the last 20 years, but the Fed's goal is to increase inflation is just about the most perverse thing. I'm sorry, I get excited about the Fed.
No, go for it.
Sorry if I sound like I'm ranting.
No,
It's the most perverse thing out.
Yeah.
The Fed's original mandate was to preserve the purchasing power of a currency. Now, they haven't exactly done a good job with that since 1913, when the Fed was brought into effect. The dollar's lost over 99% of its purchasing power. And since 1971, when we went off the gold window, it's lost 44% of its purchasing power. So they haven't exactly done a good job of preserving purchasing power. But for the Federal Reserve to say, our goal is to increase inflation, what they're actually saying, Peter Brookveld pointed this out, what they're actually saying is, we want to increase your cost of living. Well, would a central bank even say that? Of course they wouldn't. No, this idea that inflation is good is nonsense. Now, in inflation, as in anything, there's always winners and losers. You know, having interest rates that are ultra low, too low. Well, some people gain by that. Again, wealthy people who can go out and borrow money, who can pledge their assets and get loans against their assets. Wealthy people benefit by interest rates being too low, while the poor dear old lady who's 70 years old and has done the right thing all her life and put money in the bank, she suffers because she can't earn any money on her savings. But there's always winners and losers in every environment. So yes, some people win by inflation, but to say inflation is good for you and only affects wealthy people is just nonsense.
You were saying recently in July, inflation's back, but it's not yet a major issue, not yet runaway inflation. That was your opinion in July of this year. What's your opinion now in November? Are you in the same place?
Yeah, it's certainly not runaway at the moment. I mean, and I don't think we'll see runaway inflation, depending on how you define it. You know, I don't think we'll see runaway inflation imminently. So let's put numbers on that. I mean, in the next year, let's say next 12 months, I don't expect double-digit inflation. And that's because along with the inflation, there are also deflationary forces, whether it's technology or whether it's a lot of globalization is deflationary, because you can outsource to lower where workers are less expensive and so on and so on. So I'm not expecting runaway inflation anytime soon. But the problem we have here is, you know, in the past, when inflation started to move up, the Fed, albeit belatedly, until Volcker came along, the Fed reacted by tightening. I'm talking real tightening, not tapering. As you know, and I'm sure 99.9% of your listeners know, tapering, which sounds, you know, technical, all tapering is reducing the rate at which they buy new bonds. It's nothing to do with cutting. So even if they stick to this tapering plan, the Fed's balance sheet will still be higher 12 months from now when it is today. I think that's really important we understand that. This is not tightening, real tightening. But in the past, the Fed has always responded to inflation by raising interest rates, and most famously, of course, when Paul Volcker became Fed chairman, whatever it was, 1980, and raised T-bill rates went to 20%. And he got ahead of inflation. For the last 20 years, since Volcker, the Fed has always been behind inflation, and no more so than now. Again, inflation is the creation of excess liquidity. Higher consumer prices are simply the symptom of inflation, right? But they're not inflation themselves, they're the symptom of inflation. But if I use inflation to mean higher prices, excuse me, it's just a good shorthand.
Understood.
So consumer prices started going up on a monthly basis last August, whole year. A proper Federal Reserve would have started tightening at that point and got ahead of inflation. So we are well behind inflation right now. And I mean, I like to joke. You remember that Lloyd Benson line in vice presidential debates, whatever it was, 15 years ago? I knew Paul Volcker, and Jerome Powell is no Paul Volcker. We are not going to get tightening out of this guy.
Well, you know, that's a very good point. It seems to have been bred out of the PhDs that are currently inhabiting the Fed. They don't believe in the gold standard. They don't believe in any of that stuff. They don't believe in any sound money policies. One of the criticisms you've made about the current Fed is that it's just full of academics and they haven't had a businessman in there since the 1960s. Could you share your point of view on that issue with our audience?
Yeah, no, absolutely. And you know, James Grant talks about the PhD standard, which is what we have now. We don't have a gold standard, we have a PhD standard. And the problem, most of these people are not only academics, but they are lifelong academics. They are people who have never held a proper job in their life. By proper, I mean, you're not feeding at the government's teeth. You know, you're earning your way with risk and reward in the market. These people have never had that job. So they don't understand how inflation affects businesses. They don't understand how low interest rates have an impact on businesses. They don't understand these things because they've never lived it.
I think that is correct. And now we've got this situation where President Biden is looking at his next Fed chair, whether he's going to renominate Jerome Powell, or the other rumor is the MMT princess, Lael Brainard, might be the replacement. And plus he's got 3 open seats to fill. Yeah. So he could really sort of stamp his staff could basically set the Fed on a new course for the next 4 years.
Absolutely, and this is very, very damaging. I'll get to a Fed chairman in a second, but the open seats are, I think, even more important because that's 3 empty seats out of 7. So that's 4 out of 7 people he can control, and it's not as though the remaining ones are hawks. To begin with. Is it a coincidence? I'm asking a question rhetorically, but I think we know the answer.
I already know the question you're going to ask.
You know the question, right? Is it a coincidence that the Fed chairmen who were caught insider trading were both, I won't say the most hawkish, but the least dovish?
Yeah.
Of course it's not. Those trades were leaked. There's no question about that. They were leaked to, and those people decided the best course was to resign rather than to fight it. Because arguably what they did didn't violate the Fed's very, very loose insider trading standards. You know, if I had done that in my business, the SEC would come down on me with like a ton of bricks, but it violates my policy. That didn't actually violate the Fed's policy, but that's a different issue.
Yeah.
So no, it was not a coincidence that the least dovish were forced to resign. So yeah, I think that's very, very dangerous that they can, the staff, as you say, and if you look at some of the people that the Biden administration has been putting forward for economic jobs, you know, like banking supervisor, currency, these are pretty radical people who think the Soviet Union had a great economic system and we should abolish private banks. That's I forgot what job she's been appointed for. Those are the actual views of a Biden nominee for an important economic post. This is unbelievable. As you can tell, and I apologize for this because I know when I listen to an interview, rants are not particularly enjoyable. You know,
no, this is awesome.
You rant quite entertainingly. Let me tell you something.
But let me just say, I really think that what the Fed has done in the last 15 years has been criminal. It's been criminal. Their policies, whether by design or by ignorance, their policies have directly caused or directly abetted in the widening wealth gap. Their policies have, and we can talk about how that is so if you want, but they have directly been responsible for widening the wealth gap. And about a year or 2 years ago, it dawned on the Fed that their policies were widening the wealth gap, which is why we went over to the direct approach with helicopter money and MMT, because the traditional approach of buying assets and putting all that money into the New York the money center banks, was actually widening the wealth gap. That's number one. Number two, they have turned little old ladies, people who have done the right thing all their lives, they've turned those people into speculators, because people who saved and were planning to live off their retirement, well, when they're getting, what is it, 0.5% on a 1-year CD? I don't even know what you get on a CD, because I wouldn't even think of buying a CD.
Yeah, 0.1%, 0.2%, yeah.
They just can't live on it. So they're being forced to speculate, which is buying in the stock market. And frankly, when you're 80 years old, buying stocks is speculating. So those two things, and that's probably enough, those two things are criminally irresponsible, in my view.
And you see junk bond yields are just at historic lows. People are just having to go out and buy crazy risk in some of these junk bonds and getting very low yields for the risk they're taking on some of these companies. I think that's another what do you call it? That's another collateral damage to the system. Everything's mispriced because of what the Fed's doing, correct?
Everything's mispriced, and there's too many zombie companies around, which means the capital is not available for proper companies. Yeah, and the problem, of course, is people are taking risk and they're comfortable taking risk. I mean, a lot of investors today don't even look at risk. I mean, in a what I'll call normal environment, when you're an analyst or just an investor, you look at something, you listen to the story, you look at the balance sheet, you assess the potential and you assess the risk. When I talk to people one-on-one now, it seems like nobody's even looking at the risk. They might look at the risk in the market overall, but no one says, I don't want to buy whatever, you know, polymetal, because look, there's this and this and this risk. Nobody's looking at the risk anymore. And that's because the Fed, ever since Alan Greenspan and long-term capital in 1998, I think, something like that. Ever since long-term capital, the Fed has basically told the market, don't worry, the market won't go down too far. And if it does, it won't stay down for long, because we've got your back.
Well, sir, that leads into, you were just analyzing the risk of various stocks. I'm sure you're familiar with a gentleman named Tavi Costa. Crescat. This was a chart. This was a chart he put out recently, showing the free cash flow for the gold and silver miners. Which are, if gold and silver miners were their own sector, they have the best free cash flow relative to inflation of any sector in the market right now.
Amazing, and the dividend on gold stocks is higher than the S&P dividend.
Yeah,
which is another perversion.
Yeah.
Well, the gold stocks, I can only talk to the, let's talk about the XAU, the leading gold and silver stocks. They actually are net, their balance sheet is now net cash positive, which is astonishing because, I mean, in a way it's good because I'm a risk averse person. I like companies with strong balance sheets, but a mining company or any resource company, an oil company, a mining company is just about, that's the sector where you would expect debt. They need debt. It's a capital intensive business. So that's the sort of sector, to the last sector, which I would expect to be net cash positive. And yet today the XAU are cash positive, which is astonishing.
Mr. Day, we were talking earlier about Volcker when he raised rates to get ahead of inflation. Will the Fed now be able to raise interest rates without completely destroying the economy?
You've hit the nail on the head. I don't think so. The Fed, and it's not, I mean, the Fed is the one that's accommodated. The Fed has been the drug dealer that's accommodated the junkie, the junkie being the administrations, not just this one, but Trump was hardly a model of fiscal rectitude. So, but the Fed has been the drug dealer accommodating him. So for the last 40 years, really, increasingly, they have simply painted themselves into a corner. And you look at I mean, I don't think the economy, I don't think the US economy could stand significantly higher interest rates in anything like the near term. But more important than that, to me, as you know, why they've kept rates so low for so long is the federal government's debt servicing requirement.
Yeah.
You know, it's right now you've got interest rates at the lowest they've ever been in history, literally the lowest they've ever been in history. And number two, not only are the interest rates low, but the federal government over the last, say, 6 years, 7 years, has been continually shortening the duration of their financing. So when the 30 years bonds mature, they're simply rolling over into 1 year bonds. Now, they're doing that because the interest rate that they have to pay on the 1 year is lower than on the 30 year. So for those two factors, one, interest rates being low, and two, shortening the duration on the federal government debt, they've made the debt service artificially low. But even where we are today, you know, I did a calculation. If interest rates if the interest rate that the federal government paid on its debt moved back to the 30-year average that they pay on their debt, and I pick 30 years because it's after Volcker, we're not talking about that extraordinary period with Volcker, then you would be paying, then over 30% of the federal government budget will be going just to service debt.
Yeah.
Right? And we're talking average, the average over 30 years.
Yeah.
So when you get to 30% of your budget is just servicing debt, that is unsustainable because you're not moving ahead. You're not paying down debt. You're just, it just compounds on itself. What the government should be doing now, in my view, with interest rates at 5,000-year lows, literally, is doing what a lot of companies are doing, issuing long-term bonds. You know, they should be issuing 100-year bonds. Now they'd have to pay more than on a 1 year, but in the current environment with negative interest rates in most of the world, I don't know, how much would the US government have to pay on a 100-year bond? I mean, it might be 3%, but it's not going to be much more than that. I mean, if Argentina can issue 50-year bonds for 7%, the US, and they've had default after default after default, surely the US government could issue 100-year bonds for 3 or 4%.
Yeah.
Well, Greece is issuing debt right now at what, 1%, and so is Italy.
Yeah.
Thanks to the European Central Bank. And I don't know how long this can keep going on. At some point, it just, you know, it starts really. What are we now? 140% debt to GDP and climbing. By what's the deficit this year? $3 trillion. I have no idea at what point people start losing faith in the currency. But you know, final wrap-up question, and thank you very much for giving us a little bit of extended time.
No, this is good. Thank you.
Yeah. Do you see the potential for a full currency collapse if we don't change course? If there's no radical move to get our finances back under control, could the dollar completely collapse?
Yeah, well,
and I'm talking 10 years, 5 years, 10 years, you know, go out there.
I mean, I think, you know, everybody said the analogy about the dollar being the cleanest shirt in the dirty laundry basket. And one of the reasons, of course, that the dollar is as strong as it is because everyone else, not everyone, other major central banks, they're in even a worse situation. And importantly, the interest rate that you can get on euro deposits, Japanese currency deposits, etc., are lower than on the US dollar. So if I'm a Swiss investor sitting in Zurich and I've got some money that I just want to park, you know, right now I'll put it in the dollar because it yields more. And if I look at the dollar versus the yen, the dollar versus the euro, I think the dollar is just as solid as the other two. And so anyway, that's obviously the main reason that the dollar's been holding up so much. But to answer the question, I think absolutely. Because here's the thing, the dollar is the world's reserve currency. When you have a world's reserve currency, it means it enables you to issue more of your own currency than you need for your own domestic needs, because there's always a buyer somewhere. And that has a big benefit for your own economy. But so long as that continues, that's a positive. But at some point, people lose confidence. And when they lose confidence in the reserve currency, that can have devastating effects, because it's a bit like Britain in 1945 at the end of the Second World War. You know, Britain had the pound had been the world's reserve currency, right, for over a century. Central banks around the world had pounds. But come 1945, Britain's gone through a long period of decline. We had a high welfare system. We had military bases around the world that we couldn't afford. I don't know if any of that sounds familiar.
Yeah.
But and so the pound lost its status as world reserve currency because other people, companies, governments started losing confidence in the pound, right? The pound from 1945 went to 5-to-1 against the dollar, all the way down by 1980 to 1-to-1 against the dollar. 35-year decline, but a pretty dramatic decline during that period. And during that period, the economy kind of stagnated. We had high inflation. And eventually in the 60s, we even had to go and borrow money from the IMF. How humiliating for the country, but used to own, you know, a quarter of the globe. But the US is in the same position now. Their empire is not called an empire, but it's the same, you know, economically, it's the same thing. The military bases are all over the world. And when people start to lose confidence in the dollar, it's a process that, like people say, just because it's inevitable doesn't mean it's imminent, which is true. But as with all inevitable developments, once it gets underway, it tends to move much more rapidly than people imagined. Because as one person loses confidence in the dollar, so does the next person, so does the next person. And suddenly, the person that hadn't even really thought about it before says, wow, I'd better get out of these dollars. You know, what I like to say is, at the moment, you've got dollars stuffed into every central bank in the world other than Russia, which sold all their dollars for political reasons. But you've also got dollars. The Colombian drug dealer takes dollars. You know, the Romanian taxi driver takes dollars. The ladies of the night in Argentina take dollars. Everybody takes dollars, right? Well, even as recently as when I was a kid on a foreign trip, people would still accept British pounds. If I went to Mexico today and said to the shopkeeper, I've got some pounds for your milk, would they take them? No, of course not. But they would take dollars. Will they still take dollars in 10 years? I don't know. I really don't know. And that loss of confidence tends to happen, once it gets underway, it tends to happen very, very quickly. But the point, just to conclude, as I said before, all the dollars that have ever been printed, they still exist, unless they've been burned. They still exist. The Colombian drug dealer has them. The Romanian tax driver has them. All sorts of people have US dollar bills stuffed under the mattress. But once they start losing value, those dollars all start to come back to the US, which means a huge increase in the money supply.
Understood. Well, Mr. Adrian Day, we want to thank you for giving us some of your time today. It's been very entertaining.
Yeah.
We'd love to have you back in the next 3 months or so as the market.
Thank you. I'd love to.
Yeah,
I'd love to. And you can call me Adrian. Forget this Mr. Davis.
Okay. Thank you. Thank you. We appreciate it. And we'll talk to you again in about 3 months as the market.
Well, thank you. I enjoyed it very much. Good show. Thank you.